Hello everyone, my name is Joan Ngeny and I'm excited to guide you through this presentation on banking and finance. We will explore the fundamental concepts and key components of this field, which is essential to the functioning of modern economies. Let's dive in and uncover the vital role that financial institutes, markets and regulations plays in our global financial system. Okay, we'll start with the introduction to banking and finance. So banking and finance are critical to modern economies, involving the management of financial resources through institutions, markets, and regulatory frameworks. Banks, credit unions, and investment firms manage deposit and loans, channeling funds from savers to borrowers. Financial markets, where instruments like stock and bonds are traded, facilitate price discovery and liquidity. Regulatory bodies oversee these activities to ensure stability and compliance. Understanding banking and finance is crucial for grasping how capital flows and economic stability are maintained, globally and locally. Under still introduction on banking, we have the overview of financial system. A financial system consists of institutions, markets, and instruments that facilitate the transfer of money between individual businesses and governments. The components involved, we have the financial institutions such as banks, insurance companies, pension funds, and investment firms providing financial services. Another component is the financial markets, venues for buying and selling financial instruments, e.g. the stock markets and bond markets. Another is the financial instruments, assets like stocks, bonds, derivatives that represent a contract between holders and issuers. Also the regulatory bodies, organizations like the central banks and securities regulators that ensure stability and legal compliance. We have the role of financial markets. One of the roles is the resource allocation. Financial markets facilitate the efficient allocation of resources by channeling funds from savers to borrowers who need capital for investment. Another role of financial markets is the liquidity provision. Markets provide liquidity, allowing assets to be converted into cash quickly and at a fair price. Another role of the financial market is the price discovery. Financial market helps in determining the prices of financial instruments based on supply and demand. Another role is the risk sharing. Markets allow investors to diversify and manage risk by investing in a variety of financial instruments. So financial system and markets. Financial system, the network of institutions, markets, and instruments involving the transfer of money between individuals, businesses, and governments. Then financial markets is the marketplace where financial instruments such as stock, bonds, and derivatives are bought and sold, facilitating the allocation of capital and risk management. We have types of financial markets. We have the money markets, we have capital markets. Under money markets, its purpose is to facilitate short-term borrowing and lending, usually with maturities of 1 year or less. Instruments include the treasury bills, commercial papers, certificates of deposits, and repurchase agreements. Participants of the money markets is the banks, financial institutions, corporations, and government entities. Another type of financial markets is the capital markets. The purpose is to facilitate long-term funding through the issuance and trading of securities. The instruments used include the stocks, bonds, and long-term loans. The participants under the capital markets, they are individual investors, institutional investors, governments, and corporations. Another one is the primary versus secondary markets. Under primary versus secondary markets, the primary markets is the market where new securities are issued and sold for the first time. Its importance, they allow issuers, e.g. the corporations, the governments, to raise capital directly from investors. Examples of the primary markets is the initial public offerings, the IPOs, where a company offers its shares to the public for the first time. Then the secondary markets, its function, the markets where existing securities are traded among investors. Its importance: they provide liquidity, enabling investors to buy and sell securities quickly and easily. Examples of the secondary markets: we have the stock exchange, like the New York Stock Exchange and the NASDA. Okay, we have under central banking and monetary policies. The function of a central bank within a country's monetary system, responsible for regulating monetary policies, overseeing financial institutions, and maintaining economic stability. Then under monetary policies, policies are and actions implemented by a central bank to control the money supply, interest rates, and central conditions in order to achieve a macroeconomic goals such as the price stability, full employment, and economic growth. So functions of central banks: monetary policy. It implements policies to control the money supply and interest rates to achieve macroeconomic objectives, such as controlling inflation, maintaining employment, and ensuring economic stability. Another function of the central bank is the financial supervision and regulations. This oversees and regulates financial institutions to ensure that stability, protect depositors, and maintain confidence in the financial system. They are lender of last resort. They provide emergency funding to financial institutions in distress to prevent systematic failures that could harm the broader economy. Another function is the payment system management. They ensure and efficiently and security of the payment and settlement system and underpin financial transactions. Okay, monetary policy tools. We have the open market operations. The central bank buys or sells government securities in the open market to influence the level of banks' reserves and overall money supply. Another monetary policy tool is the discount rates. The interest rates charged by the central bank on short-term loans to commercial banks, lowering the discount rates, make borrowing cheaper for banks, encouraging them to lend more and thus increasing the money supply. Reserve requirements. The minimum reserve each bank must hold to customer deposits and notes. By changing the reserve requirements, central bank can directly influence the lending capacity of commercial banks. Impacts of monetary policy. Inflation control. By controlling the money supply and interest rates, central banks can influence the rate of inflation. Increasing interest rates can reduce inflation by encouraging borrowing and spending. Economic growth. Lower interest rates can stimulate investment and consumption, leading to economic growth. Conversely, higher rates can slow down an overheating economy. Employment. By managing economic cycles, central banks can influence employment levels, aiming for low unemployment. In conclusion, the field of banking and finance plays a pivotal role in the stability and growth of both national and global economies. Through the study of financial system, institutions, markets, and regulatory frameworks, individuals gain essential knowledge that empowers them to navigate complex financial landscape. Whether you are pursuing a career in banking, investment management, or financial analysis, understanding the principles of banking and finance is crucial. This foundation not only enhances your ability to make informed financial decisions, but also contributes to the broader economic well-being by promoting efficient capital allocation and risk management. Thank you.